We are really excited about this project. John from Marstone actually approached us and said, hey, we have these really awesome interns who have done this amazing work and we'd like a platform for them to share it. And so I'm going to let John actually tell you about these two wonderful young people, Sunny and Morgan, and a little bit about their project, and then they'll get started.
Thank you. First and foremost, thank you, Amy, and everyone at the Venture Cafe, and for everything putting on. I know it's a lot of work to do all the AV and get everything set up in the space. We deeply appreciate the opportunity to present our work and everything. First, a little bit about Marstone. We're a FinTech, been around for 7 years in the jewelry district. We work in the digital wealth space, and our big goals and mission is to lower the overall cost to serve for banks. So we work directly with banks, not directly with consumers. So you can imagine us working with big banks to help them with their wealth strategy and their approach. And with that, there's a very strong mission to help humanize that approach and increase financial literacy, not only for everyone, but also for underserved and various communities and diverse communities within that ecosystem. So as part of that, we want to richly understand what's happening when we go for investors, when people go to start investments. And as part of that, as you can see up here, is understanding their risk tolerance. So are you conservative or are you aggressive, and figuring that out and doing it very quickly, but also accurately. So we wanted to understand more about that. So what we did is had a giant pile of data. We handed it to Morgan and Sunny and said, hey, what can we do here? And they're amazing. I'll let them tell the full story about it. But everything that they did here was very much their approach, their ideas, they're centered. So if you think about the data science technique from the sample set, all of it was done by them. So with that, I'll give them an opportunity to explain it. And if you have any other questions, see me afterwards. With that, I'll hand it to.
Well, thank you for the introduction, John. That was great. Well, I want to introduce myself. I'm Suraj Sait. I'm a business analytics intern at Marstone. I've been here for about the past year working on these data science projects alongside Morgan. I've really enjoyed exploring the intersection of finance and data science, and I'll be studying those topics next year at the University of Pennsylvania.
Hi, as Sunny said, I'm Morgan Pryor, and I'm a current student at the University of Rhode Island studying finance, math, and computer science. Like Sunny, I've also been an intern at Marstone for a year now, and we've had a great time working together on a lot of really interesting projects. One of this is using data science techniques to explore risk tolerance, and we're both really excited to talk about it with you today.
Yeah, so let's get kicked off by talking a little bit about what risk tolerance is. And for many of you in the audience, I'm sure you're familiar with the finance space, but risk tolerance is a sort of abstract term, and it's almost difficult to quantify. So I want to first talk about it by providing an analogy with a quote by JFK. There are risks and costs to action, but they are far less than the long-range risks of comfortable inaction. And what this quote is meant to say is that with any portfolio action, anytime you execute a trade, there's always the risk that you're going to lose your initial investment amount. There's always the risk that your profits are going to be swallowed up by trading and management fees. But you have to make an attempt, right? The financial advisor has to make an attempt in order to achieve a client's financial goals. But if they're too aggressive or they're too conservative, these goals, they can't be met. And so what regulates a financial advisor in this regard is the idea of a client's risk tolerance. How much risk can a client tolerate in order for their investment goals to be achieved?
So the overall goal of this presentation is to give an overview of the project, where we have been, where we are, where we will go, and where we could go. So we began this project many months ago with the goal, as John mentioned, of exploring trends and insights within Marstone's risk tolerance questionnaire, just sort of in an exploratory way. And since risk tolerance questionnaire is a bit of a mouthful, especially considering how often we say it in this presentation, we tend to shorten that to RTQ. So we started with the goal of exploring the RTQ, ultimately with the idea that we might be able to alter Marstone's current RTQ algorithm, or just approach it in a different way to potentially make the risk predictions more accurate or improve the user experience in some way. So that was kind of what was motivating the way we looked at the insights. And then from that, we found a lot of different or insights and findings. And then we carried those conclusions to the next part of our internship, where we created our own predictive model that takes a little bit of a different approach to calculating risk tolerance. And we'll actually be able to demo that model to you guys later on in this presentation. So ultimately, we're hoping that these ideas and this work is helpful to Marstone's risk tolerance questionnaire, but also that it could be applied potentially in other projects and contexts at Marstone and beyond. So in giving this presentation to some people previously, even in practice to my family, the first question a lot of people ask is, why does it matter if there's a slight misclassification in somebody's risk tolerance? So we figured we'd lead with that. And so a misclassification in risk tolerance could be on two sides of the coin. It could be someone who should have a more conservative portfolio and they're assigned something more aggressive. And the risk there is that that person's uncomfortable with the level of exposure of that aggressive portfolio. They might be uncomfortable during a market downswing, and they might sell at an inopportune time. And the other side of the coin is that somebody who could be more aggressive is given a more conservative portfolio. And the risk there is that they miss out on that volatility and they miss out on potential market upswings. So they get unearned revenue in that way. So we attempted to quantify based on some assumptions about assets under management and the frequency with which these misclassifications occur, and landed on the estimate that about $25 billion are lost in aggregate across all wealth management firms due to misclassifications in risk tolerance.
Right. So now that you sort of understand why this is such a significant problem, we wanted to talk a little bit about the risk tolerance questionnaire in particular. So its purpose, its function, what are some of the things that go on behind the scenes? So we'll talk a little bit about that in this section. So to start off, the purpose of a risk tolerance questionnaire is twofold. It aims to evaluate the risk ability and the risk willingness of a user. And the way that it does that is through a series of questions, right? Typically around 10 to 15, revolving around subjects like liquidity needs, time horizon, behavioral finance, and more. And so with these responses to the questions, a series of calculations can be performed, and that eventually leads to a portfolio recommendation. Now, if that's a little bit confusing, you can almost think about it like the form that a doctor makes you fill out every single time you come to their office. Just as you would document your health and any changes to your health in the time since your last visit, you would also document your financial health in the RTQ.
So to go over a little bit about how the current RTQ algorithm works, first, there are about, as Sunny said, about 14 questions, and they cover a wide range of topics from liquidity needs to riskability, your willingness to take risk, your goals. And then each answer to these questions is given a general risk designation. So it might be generally labeled aggressive, it might be generally labeled conservative. And then from that qualitative general risk designation comes a numeric weighting associated with it. So for example, if the question is, what is your time horizon for this investment? If you say, I don't need this money for another 20 years, that might be considered aggressive and is rated something like a 20. However, if you say, I need this money tomorrow to send my son to college, that might be considered conservative and might be rated something like a 1. So at the end, all of those numeric weightings are summed, and the sum of the numeric weightings is used to then give a discrete classification for risk tolerance. So for example, if the sum of your weightings is between 60 and 80, perhaps you'd be given an aggressive portfolio. However, if the sum of your weightings is between 20 and 40, say, you might be given only a moderate, or not only, but you might be given a moderate conservative portfolio.
So taking into account the purpose and the process of the RTQ, Morgan and I decided to conduct some initial data exploration to better understand the nuances behind the RTQ. So this is more so diving into a user's interactions with the RTQ and what are some trends in response patterns that we see. So the first finding that we'd like to highlight is the expected portfolio distribution. And a distribution is really just a representation of how often a group of things is occurring. So in this case, we're looking at the frequency that a given risk tolerance is expected to occur. And just to give some background, the way that this was calculated was by evaluating the number of distinct ways that someone could go through the RTQ and then receive a given risk tolerance, right? So if we look at this distribution, it's considered a normal distribution. And what that means is that The mode, or the most frequently occurring risk tolerance, occurs smack dab in the middle. That's what we see with moderate right here. And then on the tail ends of the distribution, so looking at conservative and very aggressive, we would expect those distributions to occur very infrequently, if at all. I want you to focus on that idea that the tail ends of the distribution aren't expected to occur very often at all, simply because there's so few ways to get that risk tolerance.
And then looking at the actual distribution, we see that it's quite different for a couple of reasons. First of all, that those extreme values, like Sunny mentioned, the most conservative and the very aggressive investment level are achieved in much higher proportions than we would have expected given that expected distribution. And then on the other hand, what we expected to be the mode value, that moderate middle of the road portfolio, is achieved in actually not that great a proportion. So this was sort of an interesting finding that we carried forward that let us know that the underlying population that we were working with was achieving portfolios that we didn't really expect them to achieve in proportions that we weren't expecting.
Right, and to see this distributions, both the expected and the actual side by side, we can see the disparity illustrated even more. If you look at conservative, for example, it's almost about 20 times as much. The actual distribution is occurring 20 times as much as is expected to. And if you look at very aggressive, that proportion is even higher. So we found this finding to be very interesting. And we were wondering if it's perhaps because the underlying population was more aggressive, or perhaps if the questions were leaning in a certain direction, or if there were other factors at play. So when we look at the next piece of analysis, the correlation matrices, we'll try and expand on that idea further and try and investigate why there's such a strong disparity between the tail ends of this distribution.
Right, so as Sunny mentioned, the next thing we explored was correlations between questions in the questionnaire. And that lends itself to this matrix view, where we have all the questions on both the X and the Y axis, and then the cell that is their intersection point shows the correlation between those two questions. There are numbers on this slide in the cells, but they're very hard to read. So just looking at the color tells enough of the picture. With that tan or orange color, indicating a positive correlation between two questions, and then the dark purple or black indicating a negative, much lower correlation between questions. So one way to interpret this is to consider what would this matrix tell us if it were entirely orange and tan? And that would mean that user behavior is consistent throughout the entire questionnaire. So if someone behaves conservatively on the first question, they would behave conservatively throughout the entire questionnaire. And if they behaved aggressively on that first question, they would behave aggressively throughout the entire questionnaire. However, that's not what we see. This matrix isn't obviously that orange and tan color throughout. But there are sections which do have a more orange cells, showing that there are some sections of the questionnaire where the questions are positively correlated. So we've listed those off to the right. That's the view of investing, preferred outcome, risk comfort, and then reaction to different size drops in the portfolio. So the takeaway here is that, well, user behavior isn't necessarily consistent across the entire questionnaire. There are some parts which it is, and there are some parts which it clearly isn't. And that prompted us to think about how could we break risk down into different parts and try to find more order in these parts where it seems there is no consistency, and then capitalize on the fact that there are sections where people do seem to be consistent.
Right. And so we were able to find some questions of the risk tolerance questionnaire where consistency was present throughout the board. But that also begs the question, are there specific subsets of users that tend to be more consistent than others? And so if we look at the two correlation matrices that are present on the board right now, for conservative users and for aggressive users, we can see that there is a definite indication that conservative users, because of their tan color, are very consistent across the board. However, if we look at the aggressive users correlation matrix with the darker colors present, that would indicate that aggressive users are actually more inconsistent in their response patterns. Now, what's strange about that, and really what we found perplexing, is that conservative and aggressive users had similar paths or similar number of paths to achieve that risk tolerance. Yet there's such a large disparity in the way that aggressive users are responding to the RTQ. They're a lot more inconsistent despite there being similar numbers of paths for conservative and aggressive users. So we chalk that up to largely population differences and the underlying population having these different factors. But we try to explore that further with a predictive model that aims to rectify some of these issues.
Right. So as Sunny said, these findings, along with many, many others too numerous to show in this presentation, led us to the belief that different aspects of risk for the same person might be at odds with each other, and that people aren't behaving as consistently across these different facets of risk that we might expect, as we might expect. So we decided to break risk down into the different sections that we saw emerge from our findings, and then see how we could evaluate those sections in isolation and then bring them back together to create a fuller picture of risk. And that's sort of the approach that informed the model that we're about to show in the ensuing slides. So some of the difficulties in calculating risk with a predictive model are, first, the fact that we were taking something that this risk tolerance questionnaire that had 14 different questions, so 14 different inputs, and then trying to build a model from it. And a model with 14 different inputs is just not very productive. So we had to simplify that down to smaller groups and try to group these questions and streamline what were going to be the inputs of our model. Secondly, there was this issue or consideration of the weightings that are in the initial questionnaire. So the original Marstone questionnaire has, like I said, weightings assigned to different answers based on the overall risk designation. And so for this model, we were considering how should those weightings impact the model, and then also, should all people have the same types of weightings? So for maybe some users, their liquidity is the most important thing. So the way they answer the liquidity question should maybe have the highest weighting. For other people, maybe their goals is the most important driver of their risk tolerance, and perhaps the answer to the goal question should have the highest weighting. So we were trying to consider, how should we reconcile those weightings and incorporate them into our model? And then thirdly, there's the discrete classification of risk from the original Marstone questionnaire or Marstone questionnaire algorithm. So people within a range, whether they're at the bottom end of that range or at the top end of that range, are achieving the same risk level. So with a 61 and a 79, if the range is 60 to 80, both of those people would get the same aggressive portfolio. And perhaps there's more nuance there than that designation allows. So we were trying to see if through a less discrete classification, we could capture some more of that nuance.
So out of all of this chaos comes a beautiful order. In our eyes, that was dimensional scores. So the benefits of dimensional scores are threefold. They provide feature abstractions, a focus on core characteristics, and also less noise when it comes to trading a model. So to start off by talking a little bit about feature abstractions, right? So with the initial RTQ, we had 14 questions. Some of them were required by the SEC, some of them were investment firm specific, and some of them were included for the sake of the financial advisor to better understand their clients. Now, not all of that information is necessarily pertinent to creating an investment recommendation for a certain individual. Some of it is, but some of it isn't. And so we decided to filter down these 14 questions into 5 dimensions: riskability, risk willingness, liquidity, involvement, and experience. These 5 dimensions allowed us to focus on the core characteristics of a user. Right? These are the things that are most defining, most salient when it comes to predicting risk. And so we decided to hone in on those. Finally, because the 5 scores allowed us to focus in on specific characteristics, we were able to achieve a shorter range in terms of where a user might fall on their risk classification. So as Morgan mentioned previously, a user could fall at 61 and 79 within a certain range and get the same risk tolerance. With our dimensional scores, we're able to make that range a little bit shorter and allow for more consistency in the places that a user would land.
So as Sunny said, the 5 dimensions that we landed on are riskability. So that's the risk that someone is able to take sort of inherent to their current financial situation. Risk willingness, which would be more related to personality. That's the risk that somebody wants to take. Liquidity, so how easily or quickly the person plans on needing that money in their investment account. Experience, which would be simply how long somebody's been investing in the markets. and finally involvement, which is how hands-on somebody wishes to be. So we evaluate, like Sunny said, each of these in isolation, and then we bring them back together to create a broader picture or a fuller picture of somebody's risk tolerance.
So the terminology that we used to describe this fuller picture was a persona, right? We considered our personas to be somewhat holistic in that they considered 5 different dimensions of a user, right? Again, risk ability, risk willingness, liquidity, involvement, and experience. And when we were looking at the personas for each of these users, we found that there were 2 distinct types that came forth. The first we like to affectionately call Alice. The second is Bob. And so if we look at Alice, right, if we look at Alice's persona on this rater plot right here, we can see that Alice is balanced with regards to 4 of her dimensions: risk ability, risk willingness, liquidity, and involvement. However, if we look at her experience, it's a 0, meaning that she has no experience whatsoever investing in the markets. Now, in a typical RTQ, in a scoring algorithm where questions are considered in vacuum, this fact may not have been necessarily captured by the RTQ, despite it being one of the most defining characteristics of Alice's persona. So you can imagine that if Alice were to receive an aggressive portfolio and the market decided to tank 20%, well, she would most likely sell at an inopportune time. And so recognizing this sort of nuance is what our model aims to do. We want to be able to recognize these special situations, be able to predict them possibly in advance if we can, and then deliver an appropriate portfolio based on Alice's most defining characteristic. Now, the other persona that we mainly saw was Bob. Bob is balanced with regards to all 5 of his dimensions: risk ability, risk willingness, liquidity, involvement, and experience. And so his questions were responded to completely consistently throughout the RTQ. If he picked an aggressive answer option on the first question, he continued with it throughout the entirety of the RTQ. Now, Bob is someone who a normal scoring algorithm would be perfectly fine. He would get the portfolio that is expected for someone of his risk level and wouldn't have any issues. So looking at the comparison between Alice and Bob, we can see that there are definitely situations where one dimension of a user is contradictory to the rest of those dimensions and thus needs to be paid special attention to. That's what our model aims to do.
So we decided to attempt 2 different predictive models just to see how the accuracy differed and to get experience with different kinds. So first we did a multiple linear regression model, which aims to fit a linear relationship to these 5 variable inputs, which again are risk ability, risk willingness, liquidity, experience, and involvement. And the second was the neural network, which takes scores for those 5 inputs, 5 variables as inputs, and then passes them through a number of hidden layers to ultimately output a risk prediction. And these behaved a little bit differently. We were able to achieve about 90% accuracy on the multiple linear regression model and only about 60% accuracy with the neural network. Our neural network performed a lot better on the training data than on the test data. And so we think that because our sample size was so small, there might have been some overfitting there. But hopefully that with a larger sample size, we might be able to achieve better accuracy across both models.
Right. Well, so thank you guys for sticking with us this far. We'd like to reward you with a little treat, and that's going to be a demonstration of our model. So we came up with a miniature web application run in Python Flask. And if you just type this link into your phone or into your computer, whatever electronic device you have, you're going to be able to see the risk tolerance questionnaire that Morgan and I designed for our predictive model. So just a quick disclaimer, the questions provided in this risk tolerance questionnaire aren't necessarily reflective of the ones used in any specific RTQ. They're just generated by Morgan and I for the purpose of generating a portfolio recommendation for all of you. So yeah, let us know if you have any questions, if you're able to correctly navigate to the website and everything.
Just to talk through what this will output is a actual numeric score for risk level generated by the model. And we're using the multiple linear regression model here because it was a little bit better accuracy. And then also a radar plot for you based on the questions and how you would score in those 5 separate parts of risk tolerance in a sort of that Alice and Bob format that we showed previously.